Is this time different? Is 2022 going to have a repeat of 2008? Is it going to be another housing crash? Or will it be something different? Well, let's take a look at this. So I like this little chart right here. Here's the millennials. They're all hoping that the market crashes because they want to buy a house. And I'm sure a lot of you watching this video can't even hear what I'm saying or look at the data because you just know 100% home prices are going to crash. So you can't even hear what I'm having to say. But let's just take a look at the data first, okay? So what we know is that after the 2008 crisis, mortgages are safer because they're much harder to come by. No longer do we have this Wall Street game where they're bundling up these products and putting all these derivatives on them. No longer do we have people without heartbeats getting 5 homes. No longer do we have ghost cities being built like we had before. We don't have that. We can also see that the leverage in the system has been washed out. Similar like what I've been talking about in the crypto markets, you have to wash out all this leverage, and we can see this in this chart going back to 1920 right here. And what this shows us is the blue line is the federal debt and the orange line is the non-federal debt. And so this big, that big peak right there, that is right here in the 2007-2008 banking crisis. And you can see that we've wiped out all that leverage out of the system, and there's a little bit coming back, but we're nowhere levered like we were in 2008. And when you don't have a massive amount of leverage, you don't get liquidated easy. We're seeing this in the crypto markets firsthand. The other thing you have to keep in mind is that it's a completely different metric because all asset prices move off of supply and demand. Always supply and demand. Now, there's a trillion reasons why supply and demand can move, but we always go back to those two things. So what caused the Great Recession is complicated, but it's possible that insufficient supply was and still is a bigger problem than excessive demand. So what we had in 2008 was we had way too many houses. We had ghost cities, entire subdivisions in California, Arizona, Las Vegas, and Florida, entire subdivisions that people didn't live in, but yet today we have a different problem. America is short more than 5 million homes. They said even if we build for the next decade, we probably won't be able to catch back up with the amount of homes that we need. So it's a big difference, supply and demand. An oversupply, now we have an undersupply. That's how the pendulum swings. It always overcorrects the other way. All right, so now that we've set all that up, you're all waiting for me to tell you, is real estate going to crash or not? So let's dig into this. Now, I got a picture of my good buddy George here, and if you watch those videos, shout out to George, and he always asks the question, is it cheap or expensive?
Cheap, or if it's expensive.
All right, we don't know. No one can time the market. We don't try to buy things at the right time. We don't know when the top or the bottom is until we're looking backwards. What we do is we try to figure out when things are cheap or when things are expensive. Now, George broke down real estate recently looking at the Case-Shiller index, but I think it was missing some of the data that we needed to look at. So we're gonna look at the right data that you need to look at, and we're gonna look at it from multiple indicators. Again, I don't have a crystal ball, but we're gonna try to figure out, are things cheap or are things expensive? And we're gonna look at it with some corrected data. And so the first thing is the wrong metrics. What are the wrong metrics? Well, the wrong data to be looking at is Case-Shiller. I guess that's one indicator you can look at, but you gotta look at it the right way. Now, Case-Shiller is wrong in my opinion for a couple of reasons. First of all, Case-Shiller only tracks 20 out of 3,200 municipalities. So it says Case-Shiller is seriously flawed. The primary index is based on only data from only 20 of the largest metropolitan areas, but there's over 3,100 areas. That's a problem. So there's 3,100 areas. Remember, there's no such thing as the real estate market. I showed you how some areas lost 5%, some lost 50%. So you can't just track 20 cities and just say, well, that's the market. It's 3,100. And they're broken down by price, type, etc. All right, so that's a big problem. The other thing, especially now, because of what happened with the pandemic and the Zoom boom, we'll call it, people are now moving to Colorado and Wyoming and Idaho, places they wouldn't normally live because now they can work from their computer, they can work from online. And if you're only tracking the top 20 cities, you're not tracking Wyoming and Idaho. So you're missing the picture, so that's a big problem. And you can see that in some of the data right here. This is kind of highlights some of the areas that Case-Shiller is tracking. But what if I want to move here, or what if I want to move here, or what if I want to move here, or what if I want to move here? You see, there is no such thing as the real estate market. So that's one big thing. The other thing that I think is a big miss with Case-Shiller, and I'm going to break this down in depth, but the big thing they miss is they miss interest rates. All right. Nobody buys the price of the house. They buy a payment. The payment is determined by the price of the house and the interest rate. So if all you do is look at the price of the house, you completely miss the interest rate. And what we can see is from the 80s, or more specifically here in 2008, interest rates have gone down, 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 down. So that means that homes have gotten more expensive in total value, nominal value, but they've gotten cheaper in their payments. And I'm going to show you what that looks like. Oh, the other thing, it ignores input costs. Something called inflation. And so that means that the cost of goods to build the house went up. So that means lumber went up, right? We saw that. I'm going to show you a chart on lumber. Lumber, windows, concrete, labor, it all went up in price. So you can't sell a house for less than it costs to build it. If you're an appraiser, so if you want to buy a house, the bank sends out an appraiser. An appraiser has a couple different ways they can figure out what the value of that house is. One is looking at comparable sales, what are houses selling for around it, but also what's the replacement cost? What would it take to build that house today? You can't sell a house for less than it costs to build it, and so you have to take in input costs. Case-Flow doesn't look at that, and it also ignores money growth, money supply growth. So when they increase the money supply, it pushes prices up, so we have to look at that as well. So let's take a look at some of those factors so we can get the real data here. So what are the right metrics? Well, the first metric that we should really be looking at is not the total price of the house, but the affordability of the house. Now, this Case-Shiller also doesn't take into account if people's incomes go up. So we want to look at the affordability, which takes all that into consideration. Okay, I already showed you this chart. So remember, the affordability. Nobody buys the price of the house. What they buy is a payment. What we can see is per FHA, we see conventional and FHA mortgage together, 90% of home purchases are financed. So hypothetically, I haven't worked out the math, but let's say that you can buy a $500,000 house now for a $3,500 payment. I'm going to wait until the price of the home drops to $350,000 because I just know it will. But let's say interest rates go up. And I buy the house for $350,000, but my payment's still $3,500 because interest rates went up. So now I bought it at $500,000, you bought it at $350,000, but we both pay $3,500 a month for 30 years, which means we both pay the same amount for the house, regardless of what the purchase price was for the house. Now, if you pay cash, it's totally different, don't get me wrong, but less than 10% of people do that. You can see a picture of that here. And we can see another better illustration of that, if you had $1,000, how much house can you buy with $1,000? Now I've gone ahead and highlighted this big area right here. This is the 2008 peak that we had before. And what we can see, this red line, is that we can buy more and more house with $1,000. So it's the affordability. The same $1,000 buys me more and more and more and more house. So even though the price of the homes went from $350,000 to $500,000, it doesn't mean they're more expensive because my monthly payment stayed the same. Remember, it's the affordability. That's the biggest piece that I think everybody is missing. Now we can see it in a couple other ways. So this is the affordability index right here. This is in Canada, and you can see that the payments have stayed about the same. And if we're not paying the total price of the house, if we're only paying the monthly payment, then that's what we should really be looking at. So here's a Case-Shiller index that I like a lot better. This is real monthly mortgage payments. And this is adjusted for inflation. So remember, we also increased the money supply. So we need to not look at the price of the house, we need to look at the payment of the house, and we need to adjust that payment for inflation. Now, a better way to do it would also be to adjust it for income growth. I don't have that data. But what we can see, going back here to 1986, what we can see is that the affordability has actually stayed about the same. Here's 2008, when we had this big bubble. What we can see is in regards to the monthly payment, we're actually below the trend line. A little bit different. Now that's in the United States. If you're in Canada, don't worry, I got your back. You got about the same thing. Here's Vancouver, it's a little bit high. Toronto's in red. Canada overall, here's Montreal is down here. So we're low in Canada as far as the payments go, which is exactly what people pay. Now, we also have different metrics to look at as well. So remember, the money supply is manipulated. So we have to look at things priced in other things besides dollars. And so look at this chart right here. This is real estate to gold ratio. So this goes back to 1950. And so you can see it stayed about the same because we were on a gold standard, obviously. 1971, homes got cheaper in gold, and you can see that homes priced in gold have actually stayed pretty flat. Only in US dollars they've got more expensive, not in gold. We can look at it another way. Here is actually from the Federal Reserve data from Fred. This is the S&P Case-Shiller US National Home Price Index with M2 divided by M2. So here we have the home index divided by the money supply. Remember, the money supply is increasing. So what we can see here is we can see this price has dropped off of a cliff here when you divide it by the money supply. It's an inverse correlation. So you can see it's a little bit different. And then, of course, we have the input cost. Remember that. We talked about it gets more expensive to build houses, and you can't sell a house for less than you can build it. And so that's what appraisers would use, the replacement cost. So here we have lumber. Now, lumber went way up crazy high, and it has since come down. But look, it's still way over its historical levels of where it was back here in the last housing boom in 2008. So it's way more expensive to build a house today than it was in 2008. So is it cheap or is it expensive? And you can see here, remember, supply and demand. The housing shortage is worse than ever. Will take a decade of record construction to fix this problem, experts say. All right, so finally, are we going to have a crash of real estate prices, or could we have a correction of real estate prices? So things have been going up like crazy. Fannie Mae, the government, forecasts that prices will still go up, but much slower. Instead of going up at 20% a year, they're going to go up half as slow at 10% a year, and then at 3% a year. So they will decelerate, which is why you're seeing people on Redfin marking their houses down. As I said, they priced them for a 20% gain, but now they need to price them for a 3 to 5 or 10% gain. So will we have a crash? Or could we have a correction? Now, you know, we talk about different financial assets all the time. Whenever you go on a parabolic run, you make up 100% or 200% gain, you're due for a correction. No markets go up or down in a straight line, period. And we know that when markets go up that fast, that it's healthy to have a correction. If we look at other markets, we see this all the time, and it doesn't seem to be a big deal. Here's a chart of the S&P 500. This is the main stock index that everybody uses. We know we've been on the longest bull run in history, so here's the 2008 crash. Prices dropped 60% in the stock market. But since then, we've been on a parabolic run. Look at that. But has it really been? Because here we have a 21% correction. This was probably about a 20% correction. We have a 21% correction. We have a 16% correction. We have a 20% correction. We have a 35% correction. You see, nothing goes up in a straight line. It looks like a straight line when you zoom out, but you see it moves up and down. So if homes go up by 100% and they have a little correction, is that a crash? What do you define a crash as? So if homes actually dropped more than 25%, is that a crash? Is 30% a crash? Is 50% a crash? So how do we define it, first of all, and what's the difference of a correction or a crash? Now, I would say that we want to look at supply and demand, okay? So one, as we know, housing starts are down, but they're up big time historically. So supply and demand. Well, we also know, and this is a very key piece, so now this is for you. Where do you live in the country? Are you in North Dakota where prices went 5% down, or are you in Arizona where they went down 50%? So where are you? Are you in Silicon Valley where they went up by 100%, or are you somewhere else where they went up by 20%? So where are you? What we can see, remember supply and demand, is we can see in Florida, New Yorkers and Californians are flocking to Florida. So there's massive outflows and then there's massive inflows. So if you're in a state that's getting massive inflows, even though prices are expensive in Florida, they're cheap. If you're coming from New York or California, they're cheap. And so there's massive inflows there. And at the same time, as there's massive inflows there, there's massive outflows in New York. New York listen up New York, Florida sucks and you'll be back in 5 years. Probably not. I think most people end up liking it there. Now we can see this in a chart. I have a couple charts for you, don't worry. This is the combined areas with the largest net domestic migration increases. And so what do we have? Florida has the most. We can see the amount of increases here. This is also Florida, Daytona, Florida, 55,000 here, 38,000 here, 36,000 there. We also have Tennessee, we have Georgia, I don't see any New Yorks on there. I see Utah. Then we have areas that have outflows. So this is the areas that have the most outflows, and we can see, oh yeah, wouldn't you guess it? New York, New Jersey, Connecticut, and Pennsylvania have a net outflow of 377,000. So if you're in New York, New Jersey, Connecticut, or Pennsylvania, you might see your prices going down. If you're in San Jose, San Francisco, or Oakland, remember, those had the biggest gains, 100% gains. They have the second highest outflows of 182,000. So if you're in Silicon Valley, your houses could probably go down. If you're in New York, New Jersey, Connecticut, Pennsylvania, your houses could probably go down. However, if you're in places that have increases, then you could be doing pretty good, which we also have here. We have Salt Lake City, Provo, Utah. We have Boise, Idaho. We have we got Sacramento, Roseville, California. We got Tennessee. We got Fresno, California, surprisingly. We got Georgia, Ohio, and we got Jacksonville, Georgia. So Florida, Georgia is looking the best. Texas is looking pretty good as well. So those areas will do better, some will do worse. Supply and demand, figure out where you're at. What is the demand? Is it going to increase? Is it going to decrease? I would say overall, I'm betting that we have a correction and not a, I say we have a correction and not a crash. That's my opinion.